How investors actually calculate pre-money valuation. Hello. In this video, we will go over how investors calculate pre-money valuations. When an investor says, "We think your company is worth $5 million," where does that number actually come from? Is it instinct? Is it negotiation tactics? Or is there a structured financial model behind it? In reality, professional investors do not guess. They use frameworks. In this video, I'll explain how investors actually calculate pre-money valuation using the same logic applied in venture capital, private equity, and corporate finance globally. First, what is pre-money valuation? Pre-money valuation is the value of a company before new investment is added. If an investor invests $1 million into a company valued at $4 million pre-money, the post-money valuation becomes $5 million. The pre-money figure is what determines how much ownership is exchanged. So how do investors arrive at that pre-money number? They typically use one or more of the following methods. Number 1. Revenue multiples. For many growth stage companies, especially software and technology businesses, investors start with revenue multiples. This means valuing the company as a multiple of annual revenue. For example, if comparable companies in the same sector are valued at 6 times annual revenue, and your company generates $1 million per year, the implied valuation might be around $6 million. However, it is never that simple. The multiple depends on growth rate, profit margins, market size, competitive position, risk profile. A company growing at 80% annually may command a higher multiple than one growing at 15%. Investors adjust multiples based on quality and sustainability of growth. Revenue multiples are common in venture capital because many startups are not yet profitable. Tucker 1 or 2. EBITDA multiples. For profitable businesses, investors often use EBITDA multiples. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It measures operating performance. In traditional sectors, private equity firms frequently value companies as a multiple of EBITDA. For example, if comparable companies sell for 8 times EBITDA and your company generates $500,000 in EBITDA, the implied valuation may be around $4 million. Again, the multiple varies depending on stability of earnings, industry norms, capital intensity, growth prospects, risk mature. Stable companies usually trade within more predictable multiple ranges. 3. Discounted cash flow, DCF. A more analytical method is discounted cash flow, often referred to as DCF. This method projects future cash flows and discounts them back to today's value using a risk-adjusted discount rate. The idea is simple. A dollar received in 5 years is worth less than a dollar received today, so investors estimate expected future cash flow, growth trajectory, terminal value at the end of projection, appropriate discount rate reflecting risk. Higher risk leads to a higher discount rate, which lowers valuation. DCF is powerful but sensitive to assumptions. Small changes in growth rate or discount rate can significantly alter valuation. This is why investors often use DCF alongside other methods, not alone. 4. The venture capital method. For early-stage startups, investors frequently use the venture capital method. Instead of valuing based on current performance, they work backwards from a future exit. For example, an investor may believe the company could be sold in 5 years for $50 million. They target a required internal rate of return, often referred to as IRR, of, say, 30% annually. Using that required return, they calculate what the company must be worth today in order to justify the investment. Then they adjust for dilution and expected ownership percentage. This approach explains why early-stage valuations can feel aggressive, because investors are pricing in high required returns due to high risk. 5. Comparable transactions. Another method involves looking at actual acquisition transactions. If similar companies recently sold for certain multiples, investors use those benchmarks as reference points. This is particularly common in mergers and acquisitions. For example, if similar healthcare technology firms recently sold for 7 times revenue, that becomes a negotiation anchor. However, investors adjust for geography, size differences, market timing, profitability, strategic fit. Comparables provide market context, but not exact answers. 6. Risk adjustments. Regardless of method, investors always adjust for risk. Risk factors include customer concentration, regulatory uncertainty, founder dependency, market volatility, competitive pressure, Execution risk. Higher perceived risk increases the discount rate or lowers the applied multiple. This is why two companies with identical revenue can receive different valuations. Valuation is not just math, it is risk-adjusted math. Sector 7. Stage-based weighting. Professional investors rarely rely on one method alone. Instead, they apply multiple methods and weight them based on relevance. For example, early-stage startup, heavier weighting on venture capital method and revenue multiples. Growth stage company, revenue multiples and DCF. Mature profitable business, EBITDA multiples and DCF. The final pre-money valuation often reflects a blended conclusion. This triangulation increases defensibility. Yakris. Why founders and investors disagree. Founders often focus on potential. Investors focus on probability. Founders may project best-case scenarios. Investors discount for execution risk. This gap creates valuation tension. Understanding investor methodology allows founders to prepare stronger, more realistic valuation cases. Docker. Practical example. Let's imagine a software company generating $2 million in annual recurring revenue, growing at 50% annually with strong gross margins. An investor might start with revenue multiples, perhaps 6 to 8 times revenue based on sector comparables, cross-check with a discounted cash flow model, then assess risk factors such as market competition and customer retention. After triangulation, they may conclude a pre-money valuation range between 12 and 15 million. The final number reflects growth, margin quality, market conditions, risk adjustments, negotiation dynamics. It is structured, not arbitrary. Thurstar. Final thoughts. Investors calculate pre-money valuation using financial frameworks, revenue multiples, EBITDA multiples, discounted cash flow, venture capital modeling, comparable transactions, all adjusted for risk. Valuation is not guesswork. It is structured analysis influenced by market data and future expectations. If you want to understand how these methods apply to your business, you can explore structured valuation tools at www.valuationforyou.com. And if this video was helpful, subscribe for more practical guidance on business valuation and financial strategy.